Hi, and welcome to Market Conversations. Do you have a small portfolio that you're trying to build? Well, in this video, I'm going to show you two option strategies that you can use to build up a very small portfolio. So I'm going to be talking a little bit about KWEB. So KWEB is the Crane Shares CSI China Internet ETF. So it says KWEB tracks the CSI Overseas China Internet Index, which consists of China-based companies whose primary business or businesses are focused on internet and internet-related technology. The index is free float market capitalization weighted and includes publicly traded securities on either the Hong Kong Stock Exchange, Nasdaq Stock Exchange, or New York Stock Exchange. KWEB provides access to Chinese internet companies that provide similar services as Google, Facebook, Twitter, eBay, Amazon. So the reason why I am going to show you guys a trade on this ticker is because it has been doing very poorly in 2021. But I do believe that this year is the year that Chinese stocks are going to bounce back. Probably won't bounce back to all-time highs, but it will bounce back from its lows. So right now we see this blue trend line. It did bounce from there. So the first time it bounced off was back in August, and then we see it in December, and just recently we have bounced off of it. So Baba is part of this, and we see that Baba has bounced off from this very strong trend line as well many times throughout last year. Last week it has been very bullish, so I decided to trade this ticker. But before I continue, just want to let you know that I am not a financial advisor. This is just for entertainment purposes only. I also have a Discord server that I'm trying to build with my good friend. If you guys are interested in sharing ideas or getting some of our alerts, definitely come check it out. We do have many members that's already joined, and we have Selling Option Premium who has many years selling options, and so far he's collected $19,000 in premiums since December. The strategy that I'm going to talk about is called the put credit spread. So we're going to go all the way down here and we're going to see if we can find the put credit spread. So here it is. It's also called the bull put spread. It says a bullish vertical spread strategy which has limited risk and reward. It combines a long and short put, which caps the upside but also the downside. The goal is for the stock to be above strike B, which allows both puts to expire worthless. This strategy is almost neutral to changes in volatility. Time decay is helpful while it is profitable, but harmful when it is losing. So I am going to show you this on Robinhood, and the reason why I'm choosing Robinhood because it is very user-friendly and it's very easy to follow. So it does consist of two legs. Typically, we want to open up a put credit spread 30 to 45 days out. So I would choose February 18th. So we are going to sell a put. I'm going to sell a put right below where the stock is currently trading at. I will go to 34.42. Next leg will be a buy a put right below where we sold the put. We can see here our expected profit and loss is $37 as long as the stock closes above 34.42. We will still be profitable as long as it is above 34.05, and that's because we did receive a $37 premium. We will start losing money if it expires below 34.05. So we can take a look here. We are selling one put and buying one put. Go to continue. I have one contract. Limit price is 37. Minimum credit 37. Review the order, and it says my collateral is $100. So we do need to put up the collateral. So in this case, we are going to make about a 37% return if the stock closes above 34.42. That is a very decent profit in just a little over a month. And as you can see, only $100, which is perfect because I only have $209 of buying power. So this is one strategy. The next strategy I'm going to show you is called the call debit spread. So we're going to go back to our optionstrat.com and look for the call debit spread. Here we go. It is called a bull call spread. It says a bullish vertical spread strategy which has limited risk and reward. It combines a long call and a short call which caps the upside but also the downside. The goal is for the stock to be above strike B at expiration. This strategy is almost neutral to changes in volatility. Time decay is helpful while it is profitable but harmful when it is losing. We can see that this P&L chart is similar to the one from early, the put credit spread. So this is just another way if you are bullish on the stock. Same thing, limited profit, limited loss. So I'm going to show you how that's done as well. So we're going to go back to Robinhood, and this time we're still going to choose the February 18 expiration date. So I'm going to go ahead and clear this out. So in this case, we're going to buy a call and sell a call. So let's say that we believe that the stock is going to go to at least 36.42 on expiration dates. So what we want to do is we're going to sell the 36.42, which is above where the stock is currently trading at, and we're going to buy below where the stock is currently trading at, 35.42. So as you can see here, instead of receiving a credit, we will actually pay a debit. So that's why it's called call debit spread. So let's take a look at this P&L graph. As long as it's above 35.91, we will make a profit, and if it's above 36.42, we will be able to make a $51 profit, and all we have to pay is $49. We can see here our max cost is only $49. Look, I can easily buy 4 of these, but we don't want to do that. We wanted to trade small and trade often. As long as it's above what our strike price, 36.42, we will be able to make 100% of this trade. And look where the stock is trading at. It's only at 36.10. So we are very close to the strike price, but we would only get the max profit if it closes above it on expiration dates. If it's above it before expiration dates, I will show you how you can determine how much you're going to make. So we're going to go back to option strat. We're going to click on the bull call spread. We're going to change this to KWEB and change the date to February 18th. So we can see that our short put was at 36.42 and our long put, it was at 35.42. It tells you everything here. Net debit $49, max profit $51, and let's say it does go up to $40 on January 31st, we would still make a profit of $34. So the only time we would actually make max profit is on expiration dates. Even if it goes to 41.20, we would still make max profit. So this is a good way to determine how much you're going to make at a certain date at a certain price. And this is a great strategy if you are trying to build up a very small portfolio. We want to try to stay away from buying out of the money weekly call options. We would have to get very lucky in order to make money on those out of the money weekly calls. This way, we base it on the chart. We can see that it bounced off the support. So as long as we try to bounce back above the SMA 20, we should be good with those 2 trade ideas that I just presented to you. Let me know in the comments down below what you think of them and if you want to do them together. And hope to see you guys in the Discord.